As anticipated, the Federal Reserve has cut interest rates by 25 basis points for the first time in over a decade. Signals for this were very well telegraphed through the June policy meet. But let's do a three-point analysis to understand the policy fine print and the implications that this will have. 1. What does the Fed policy state? The Fed says that it has decided to cut rates in the light of a global economic slowdown and also the muted inflation pressures. Also adding that it will continue to monitor how incoming information will affect the economy going forward. However, US markets dipped post the Fed announcement, and also what spooked the markets has been the uncertain outlook for rate cuts in the near future. The Fed statement emphasizes that the domestic labor market remains strong and that economic activity has been rising. Also, consumption growth has bounced back. Jerome Powell has also clarified that there is nothing in the US economy that presents a prominent near-term threat and that downside risks are really coming from abroad. Risks from slowdown in the global economy, along with a persistent low inflation environment, also is affecting the domestic manufacturing sector and the business investment environment as well. 2. What concerns have been mentioned by the US Fed? Well, among the key risks is trade uncertainty. Fed Chair Powell also says that mechanical effects of higher tariffs are quite small when you compare it with the size of the US economy. However, the real impact of the trade spat can be seen visible through deterioration of the business confidence for manufacturing businesses due to its dependence on supply chain across the international borders. Further elaborating on financial stability, the Fed remarked that the overall US financial system appears quite resilient. Key parameters like household borrowing is low and also banks' balance sheet is quite strong at the moment. Valuation pressures are visible for few financial markets, but they are not alarming at the moment. However, Powell also admits that a highly leveraged business sector could act as an amplifier to a downturn. 3. What are the implications of a rate cut by Fed? Well, the Fed mentions that this rate cut decision is a mid-cycle adjustment and is aimed at sustaining the expansion of the economy. Now, this means that the current rate decision is not a start of the series of policy rate cuts which normally accompany a severe economic slowdown or recession. So, the Fed going forward may respond to select variables related to the downside risks from a weak global growth and trade policy uncertainty, and also the higher uncertainty related to the business investment. Along with that, domestic inflation has been muted and global disinflationary pressures quite persist right now. We at Moneycontrol Research believe that the monetary accommodation is likely to extend for the foreseeable future, as the reasons for the same will not rectify soon. In fact, in coming months, other developed markets like central banks are also expected to add to the monetary policy accommodation. And in our view, this scenario comes as a reprieve for global equity markets, particularly if there is a thaw in the economic slowdown as well.